Hey everyone, Emily Carter here. In our last lesson, we talked about how investors make money through capital gains, dividends, and the power of compounding. But there's one big question left. Who keeps this entire system running? Behind every trade, every price movement, and every investor's success, there's an entire network of organizations and people that make the U.S. stock market function safely and efficiently. So today, we're going behind the scenes to uncover who regulates the market, who trades in it, and how everything stays connected. Let's get into it. Let's start with the referee of the game, the Securities and Exchange Commission, or simply the SEC. The SEC was created back in the 1930s, right after the Great Depression, when the market crash wiped out millions of investors. Its mission is simple but powerful: to protect investors, maintain fair markets, and make sure everyone plays by the same rules. Think of the SEC as the watchdog that ensures companies tell the truth about their finances and that no one cheats. No insider trading, no market manipulation, no fake numbers. Every time a company releases its financial results, that information has to be accurate. And it's the SEC's job to make sure it is. That's why public companies are required to file detailed reports, things like the 10K, which is their official annual report. The 10K lays out everything investors need to know: revenue, profit, business risks, even how management views the company's performance. It's long, but it's gold. If you really want to understand a business, the 10K is where the truth lives. So whenever you see SEC filing or open a company's 10K on a site like Yahoo Finance or Edgar, that's transparency in action. And it's one of the biggest reasons investors all over the world trust the U.S. markets. Now, let's talk about who actually participates in the market. Broadly speaking, there are two main groups: institutional investors and retail investors. Retail investors are everyday people, individuals like you and me, investing through platforms like Fidelity, Robinhood, or Interactive Brokers. They might buy a few shares of Apple or an index fund for their retirement. Institutional investors, on the other hand, are the giants: pension funds, mutual funds, hedge funds, insurance companies, and large banks. They manage billions, sometimes trillions of dollars, and their decisions can move entire markets. Here's the key difference. Retail investors tend to focus on long-term goals, like building wealth or saving for retirement. Institutions often trade in larger volumes, sometimes daily, to rebalance portfolios or take advantage of short-term opportunities. But both groups are essential. Retail investors bring diversity and stability to the market, while institutions bring liquidity and efficiency. Together, they form the heartbeat of modern investing. So, how does your trade, the one you place from your phone or computer, actually happen? Here's the path your order follows. When you click buy or sell, your broker, like Fidelity or Robinhood, sends that order to the stock exchange. But the actual matching of buyers and sellers is done by market makers. Market makers are financial firms that stand ready to buy or sell a stock at any time. They provide liquidity, meaning there's always someone on the other side of your trade. Without them, prices would be unstable and trading would slow down dramatically. Then there are brokers, the middlemen who execute your trades and make sure you get the best available price. They charge a small fee or sometimes earn money through payment for order flow. Basically, they route your trades to certain market makers who pay for that volume. And finally, we have ETFs, exchange-traded funds. ETFs are like baskets of stocks that track an index, such as the S&P 500 or NASDAQ 100. They've become one of the most popular ways for both retail and institutional investors to access the market, offering instant diversification with a single click. So when you put all these pieces together, regulators, institutions, retail investors, brokers, market makers, and ETFs, you start to see the incredible machine behind the U.S. stock market. It's a complex ecosystem, but every part plays a role in keeping it fair, efficient, and accessible. The SEC sets the rules. Institutions and retail investors provide the capital. Brokers and market makers keep trades flowing, and ETFs make diversification simple for everyone. So here's your big takeaway from today's lesson. The stock market isn't just a place where prices flash on a screen. It's a living ecosystem powered by people, institutions, and rules. The SEC protects investors and keeps the system fair. Institutions and retail investors supply the money that fuels growth. Brokers, market makers, and ETFs keep everything connected, liquid, and efficient. Once you understand who's behind the scenes, you can navigate the market with much more confidence. And in our next lesson, we'll zoom in on something every investor should know: the difference between common and preferred stocks. We'll talk about what each type of stock actually represents, how ownership and voting rights work, and how dividends are handled for both. So stay tuned, hit that subscribe button, and I'll see you in Lesson 4: Common versus Preferred Stocks.